We're analyzing Tyson Foods, stock ticker TSN, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Tyson Foods. Then we're giving a final rating to the business. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. There will be a key bonus metric along the way that just might be the tipping point when analyzing Tyson Foods for your stock portfolio. Before we get into these valuable metrics, let's understand Tyson Foods stock performance. Right now, Tyson Foods trades for $55.41 per share. Year to date, their stock price is down 13%. Tyson had a big drop after it last reported earnings. In the last 5 years, Tyson Foods is down 7% overall. They're down 1.5% compounded annually. In the last 10 years, they're compounding at 6% annually. They're up 81.5%. Going back before the global financial crisis, in the last 18.5 years, Tyson Foods is compounding at 6.5% annually. Right now, Tyson Foods pays a big 3.43% dividend yield. Their average dividend yield over this time is added to the returns in their stock price. Tyson Foods has increased their dividends for each of the last 8 years. Tyson's trading $33 below their 52-week high. They're up just $8 from their 52-week low. Around 1.5% of their shares are sold short. Tyson is a big business. They have nearly a $20 billion market cap. But the burning question is, why should we be paying close attention to Tyson Foods? Tyson Foods is a protein-focused food producer selling raw chicken, beef, pork, and prepared foods. Chicken and beef are its two largest segments, each comprising around 1/3 of U.S. sales. Prepaid foods constitute roughly 20% of sales and include brands like Tyson, Jimmy Dean, Hillshire Farm, Ballpark, and Sara Lee. However, most of these are in product categories rife with competition, where Tyson does not have a massive market share lead. Tyson sells some products overseas, but the international segment accounts for just 5% of total revenues. The company is an active acquirer, with more recent years' purchases focused on international and food service markets. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Tyson's average return on capital in the last 5 years to be above 14%. Tyson has earned pretty stable low to mid-teens returns on capital throughout these years. In their last year, they earned 14% returns on capital. When these are averaged out, Tyson's earning around 12.5% returns in a given year. While that's solidly above average, that's just a couple percentage points below our benchmark, meaning this is an X on metric number 1 for Tyson. Metric number 2, we're looking for growth. We want to see 5-year revenue, net income, and free cash flow growth. All three need to be up, as this metric's all or nothing. We'll include their numbers up until today in our growth calculations. In this time, Tyson's grown their revenues by 34%. The company's earnings had done well up until their last fiscal year. In their last 12 months, their earnings are down 50% from where they were at in 2018. Tyson's gross profits have suffered. They also had an income tax expense, whereas in 2018 they had a tax credit. Most importantly, Tyson's free cash flows have plummeted by 95%. This comes on the back in change in inventories, a change in income taxes, and increased capital expenditures for the business, with a reduction in their cash from operations. All of these are contributing in the wrong direction for Tyson. Because their earnings and free cash flows are down, this is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. This looks at Tyson from the view of an individual shareholder. We learned their net incomes or their earnings have been cut in half over this time, but Tyson's bought back a small amount of their shares, offsetting some of this earnings decline. Tyson's repurchased 3% of their shares outstanding in this time. While that could be good for long-term shareholders, that's not enough to outpace their decline in their earnings. This is an X on metric number 3, as Tyson's earnings per share are down. We're still looking for our first check of the day for Tyson. Does the business have what it takes to turn it around in the second half of our analysis? Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is also going to be rough for Tyson. Their free cash flows are down 95%. Their small share buybacks aren't going to outpace this, meaning this is an X on metric number 4 as well. During recessions, it's overly levered businesses that can have the biggest losses. Metric number 5, we want Tyson's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Tyson ended last year with $7.7 billion in net debt. They brought this down over this time. Right now, the company has $8.3 billion of net debt. While they have very low current free cash flows, Tyson's actually supported their debt position when we add up all their last 5 fiscal years worth of free cash flow. Tyson's generated $9.1 billion of free cash flow in that time. which covers their debt position. This is our first check of the day, coming in on metric number 5. On a historical basis, they cover their debt loads. Tyson needs to turn their current free cash flows around to support this into the future. Before we get to the first of 2 different ways we're estimating Tyson's fair value, let's not forget about our bonus. As our bonus, we're looking at Tyson's dividend profile. Right now, Tyson pays a big 3.43% dividend yield. People make mistakes all the time by blindly chasing dividends. We want Tyson to support their dividends using their free cash flows. That's been the case in all 5 of their last fiscal years. Tyson has also grown their dividends per share over this time. This all looks good for the business, even as Tyson's free cash flows have declined. While they've supported this in their last 5 fiscal years, they haven't supported their dividends in their last 12 months, which is what we're looking for specifically in our bonus. This means this is an X on our bonus. Keep in mind, this is a snapshot of Tyson's last 5 years of results, and it's no guarantee for the future. Now it's time to find out what Tyson's potentially worth. The big metric of them all, metric number 6, we want Tyson's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Tyson. Right now, Tyson has a $28 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Tyson similar to it being a private company. In the last 5 years, we learned Tyson generated $9.1 billion of free cash flow, meaning in an average year, they generate around $1.8 billion of free cash flow. When that's divided by their $28 billion enterprise value, we get a 6.4% average free cash flow to enterprise value yield. On a current basis, Tyson only generated $95 million of free cash flow in their last 12 months. When that's divided by their $28 billion enterprise value, we only get a 0.3% current free cash flow to enterprise value yield. These yields are split on either side of the 10-year treasury. This metric is focused on Tyson's historical performance, so this is a check on metric number 6. You want to be mindful of where their cash flows are at currently. Even though this is a check, don't just run out and go buy the business. We still need to estimate Tyson's fair value per share and give our final rating. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Tyson, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Tyson's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Tyson. Tyson's business has been moderately predictable in its past, which better informs our assumptions. Assuming Tyson grows their average 3-year free cash flows at a rate of 4% annually for the next decade, then in the following decade, assuming that these grow at 2% annually, we're adding in Tyson's tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of Tyson's fair value per share is around $52. That's down slightly from the company's current stock price. There are some key points you want to be mindful of. Tyson's current free cash flows are well below their 3-year average. The company's free cash flows would need to rebound by quite a bit to get back to these levels. Also, this discount rate is an estimate of total returns to shareholders. It includes both Tyson's dividend yield and any gains in their stock price. Tyson's been moderately predictable in its past, but that's no guarantee for the future. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Tyson Foods, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Tyson. What are they? Looking at the factors supporting a long thesis, number 1, Tyson can grow its international sales more easily than other food companies, as raw meat doesn't need to adapt to local tastes like prepared foods do. Additionally, meat consumption usually rises with a growing middle class. Number 2, given Tyson's immense scale in US meat production, it can leverage its distribution to expand its higher margin prepared foods reach through its existing channels. Number 3, Tyson's diverse portfolio of proteins can adapt to evolving consumer tastes and preferences more easily than individual protein exposure would give. It wouldn't be fair if we didn't cover the negatives of Tyson's business as well. Looking at the factors supporting a short thesis, number 1, although new entrants may not eat into Tyson's dominant position in commoditized protein, niche startups in alternative protein could impede Tyson's growth potential and its retail standing. Number 2, Tyson faces commodity price exposure through both costs and selling prices. Selling mostly raw meat, Tyson may not always be able to pass along costs to the end consumer with higher prices without realizing decreased volumes. Number 3, food is a competitive space, and given Tyson's undifferentiated commodity portfolio, which lacks brand power, it's always at risk of price competition. There you have it for a balanced perspective of some of the qualitative factors of Tyson's business. Now it's time to give our rating. In analyzing Tyson Foods, stock ticker TSN, we learned this protein producer earns above average returns on capital, coming in just below the benchmark we'd be looking for. While their revenues have grown, their earnings and free cash flows have suffered recently due to a variety of changes in their business. Tyson's bought back a small amount of their shares. Even though their free cash flows are down, they can support their debt on a historical basis. Tyson's also supported a growing dividend in the last 8 years. Although they don't fully support their dividend today, it's worth reiterating this analysis is not financial advice. Tyson's average free cash flow to enterprise value yield looks attractive compared to the yield of the 10-year treasury, but their current yield does not. When we performed our discounted cash flow analysis, based on those assumptions, if today's valuation multiples are the same 20 years into the future and you want a 15% rate of return, an estimate of Tyson's fair value per share is around $52. The company was recently at those levels in the end of July of 2023. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. Looking at all the factors of our analysis, Tyson looks like a strong candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Tyson, and let me know what business to look at next in the comments below. Thanks for learning about Tyson Foods with me, and have a great day.